No revolution was televised. No declaration was signed in front of cheering crowds. No borders changed on a map. And yet, sometime in the second half of the 20th century, the rules of the global economy were quietly rewritten. Factories moved, currencies floated, capital crossed oceans at the speed of light. Entire industries vanished from one continent and reappeared on another. The transformation did not arrive with tanks or manifestos. It arrived through agreements, negotiated in conference halls, drafted by technocrats, signed by ministers, and rarely read by the people whose lives they would alter. These were not secret in the sense of hidden. They were secret in the sense of being invisible to everyday experience. And together, they rewired global capitalism. In 1944, with World War II still raging, representatives from 44 nations gathered in Bretton Woods, New Hampshire. The world economy had collapsed once before in the Great Depression. Competitive devaluations, tariffs, and financial panic had fueled extremism and war. The lesson was clear. Capitalism needed structure. The Bretton Woods Agreement created the International Monetary Fund and the World Bank. Currencies were pegged to the US dollar, and the dollar was pegged to gold. Capital controls were common. Financial markets were constrained. Governments had room to manage employment, wages, and industrial policy. For nearly 3 decades, this system produced remarkable growth. Western Europe rebuilt, Japan industrialized, the United States expanded its middle class. This era is often remembered as capitalism's golden age, but it was a managed capitalism, embedded in rules that limited capital mobility and prioritized stability over speed. Yet stability contains tension. By the late 1960s, the United States was facing mounting deficits, inflation pressures, and the cost of war abroad. The fixed exchange rate system began to strain under its own rigidity. In 1971, President Richard Nixon suspended the dollar's convertibility into gold. It was a temporary measure that became permanent. The Bretton Woods system collapsed. Currencies began to float. Exchange rates fluctuated according to markets rather than agreements. This was the first major rewiring. Money was no longer anchored to a fixed standard. It became more flexible and more volatile. The second turning point emerged in the late 1970s and early 1980s. Inflation surged across advanced economies. Debt crises engulfed Latin America. Policymakers turned toward deregulation and liberalization. Under what later became known as the Washington Consensus, governments reduced trade barriers, privatized state-owned enterprises, liberalized financial systems, and opened capital accounts. Countries seeking IMF assistance were often required to adopt structural adjustment programs, reforms designed to stabilize economies but which also reshaped domestic policy frameworks. Simultaneously, trade agreements deepened integration. The creation of the World Trade Organization in 1995 formalized rules governing global trade. Regional agreements like NAFTA bound supply chains across borders. The European Union advanced monetary integration, culminating in the euro. Another deal, less visible but equally transformative, was the gradual dismantling of capital controls in advanced economies. The United States, the United Kingdom, and others liberalized financial markets. Banks expanded globally. Investment flows accelerated. Then came financial innovation. Derivatives markets expanded dramatically in the 1990s and early 2000s. Securitization transformed mortgages and loans into tradable assets. Risk was dispersed but also obscured. Each step was justified as modernization. Each reform promised efficiency, growth, and opportunity. And together, they changed the DNA of capitalism.
What these agreements accomplished was a shift from nationally contained capitalism to globally networked capitalism. Under the Bretton Woods era, governments could regulate capital flows and pursue domestic objectives with relative autonomy. After liberalization, capital mobility became a defining feature. When money can move instantly across borders, governments must compete to attract and retain it. Tax regimes adjust, regulations soften, labor markets become more flexible, policy space narrows. This is not conspiracy, it is structural incentive. Floating exchange rates allowed adjustment, but also introduced currency risk. Liberalized finance increased access to credit, but amplified volatility. Trade integration lowered consumer prices, but exposed workers to global competition. Corporations responded rationally. They built global supply chains optimized for cost efficiency. Production shifted to regions with lower labor costs. Just-in-time logistics minimized inventory. The result was extraordinary growth in global trade and a dramatic reduction in extreme poverty, particularly in parts of Asia. At the same time, income inequality widened in many advanced economies. Industrial employment declined in regions unable to compete. Capital gained flexibility, labor often did not. Financial markets expanded to multiples of global GDP. Cross-border capital flows surged. But the same interconnectedness that increased efficiency also transmitted shocks. When crises struck, in Asia in 1997, in Russia in 1998, in the United States in 2008, contagion spread quickly through the very networks designed to integrate the system. The rewiring made capitalism faster, larger, and more complex. It also made it more fragile.
Today, the legacy of those deals shapes daily life in ways that feel ordinary. The smartphone in your hand contains components sourced from multiple continents. The pension fund invested in your retirement holds assets across dozens of countries. Central bank decisions in Washington or Frankfurt influence mortgage rates in cities thousands of miles away. When the COVID-19 pandemic disrupted supply chains, shortages rippled globally. A lockdown in one region affected production worldwide. The efficiency built over decades revealed its vulnerability. Now, policymakers speak of resilience, de-risking, and strategic autonomy. Trade tensions rise, industrial policies re-emerge, capital controls are debated in new forms. But unwinding the system is difficult. Infrastructure, contracts, and institutions are deeply embedded. The global economy is no longer a collection of separate engines. It is a single, interconnected machine. The agreements that rewired capitalism created not only opportunity, but dependency. The secret deals that reshaped global capitalism were not drafted with malicious intent. They were pragmatic responses to crisis, stagnation, and inefficiency. They stabilized currencies, expanded trade, unlocked investment, and accelerated growth. They lifted millions out of poverty and integrated markets across continents. But every design contains trade-offs. A system optimized for efficiency may sacrifice resilience. A framework built for capital mobility may constrain democratic choice. Integration can generate prosperity and vulnerability at the same time. The rewiring of capitalism did not end history. It set the stage for the next chapter. And as nations reconsider supply chains, regulate technology, and rethink financial oversight, they are not dismantling the past, they are negotiating its evolution. The next transformation will not be announced with fanfare. It will emerge from committees, negotiations, and agreements that seem technical and distant, just as before. Because in the modern world, revolutions in power rarely begin in the streets. They begin in the fine print.